السلام عليكم. النهاردة هندخل في Chapter 2 Accounting for Bank and Cash Transactions. First of all خلينا ناخد introduction عن Chapter 2. أول نقطة بتقولي The statement of financial position is a statement of business assets and liabilities. النقطة التانية بتقول Assets are debit balances on account but liabilities and capital are credit balances on account. The business SOFP or Statement of Financial Position shows the business financial position after all transactions up to the balance sheet and represents the starting point for all future transactions. The accounts are the fundamental working tools of the bookkeepers and accountants having specific methods of working and properties. Cash and bank account are liquid accounts requiring careful control and maintenance. Cash and bank transactions will show receipts, payment, and balances. Cash and cash book is a combination of two assets in a single account. بعد كده بيشرح لك يعني ايه statement of financial position properties. The statement of financial position is a statement of assets and liabilities as at a specific point in time. An important financial report requiring a clear explanatory title, summarized and subtotaled to maximize user information content, which is fixed assets. Net current assets equal current assets less current liabilities. Total assets less current liabilities equal fixed assets add net current assets. Long-term liabilities. Owner's capital equal total assets less current liabilities less long-term liabilities. The accounting equation must always be satisfied in the Statement of Financial Position report. Each item in the Statement of Financial Position is an account in the nominal ledger, which is the book where all financial accounts are held. Each account will have either a debit or credit balance on account, where debit balances on account or LHS. Debit balances on account are assets or expenditure items. Number 2, credit balance on account or RHS. Credit balances on account are liabilities or capital or income items. The statement of financial position can be shown as a list of debit and credit balances. For example, assets or debit balances on account, such as fixed assets, inventory, account receivables, cash account, and liabilities and capital or credit balances on account, such as accounts payable, bank overdraft, long-term loans, and capital. Note, the above listing approach displaying assets and liabilities clearly highlights assets as items owned by the business and liabilities including capital as the sources of finance for these assets. The statement of financial position and opening business transaction. When a business is commenced, the business entity and money measurement principles are recognized. All transactions, including opening business, must recognize the dual effect of transaction. An increase in an asset account, which is debit, equal a corresponding increase in a liability or the capital account, which is credit, or reduction in another liability. An increase in a liability or the capital account, which is credit, equal a corresponding increase in an asset account, which is debit, or reduction in another liability or capital. The accounting equation must be specified for all business transactions. As we see here, that the basic equation, assets equal liabilities plus owner's equity. If we expand this equation, it will be assets equal liabilities plus, and the owner's equity will expand to owner's capital minus owner's drawing plus revenues minus expenses. As we said before, that the owner's capital and revenues increase the owner's equity, but the owner's drawing and expenses reduce the owner's equity. So what is the debit or credit effect? When the assets increase, it will be debit. When the assets decrease, it will be credit. When the liabilities increase, it will be credit. And when the liabilities decrease, it will be debit. When the owner's capital increase, it will be credit. And if the owner's capital decrease, it will be debit. If the owner's drawing increase, it will be debit. And if the owner's drawing decrease, it will be credit. If the revenues increase, it will be credit, and when it decrease, it will be debit. When the expenses increase, it will be debit, and when decrease, it will be credit. Example 2.1. Business setup transactions. Crimity commenced in a business on 1 October. On that day and before any trading transactions were made, Crimity made the following business setup transactions. Transaction details. Opened a business bank account and deposited 10,000 sterling pound of his personal funds into it. Took out a long-term business loan of 5,000 sterling pound, the loan funds being deposited into the business bank account. Acquired shop fittings and a computer for the business. The total cost was 9,800 sterling pound paid for using the business bank account. Made a transfer of 1,700 sterling pound from the business bank account to hold as a cash. Purchased inventory for resale by the business for 1,500 sterling pounds, payment being made in cash. Required. Number A. Identify the names of the accounts to be debited and credited for each of the transactions described above. Number B. Complete the table below to show a list of assets and a list of liabilities and capital and the balancing value. Assets or debit balances on account, fixed assets, inventory, bank account, and cash account. Liabilities and capital or credit balances on account, long-term loans, and capital. Number 1. Opened a business bank account and deposited 10,000 sterling pound of his personal funds into it. So the account to be debited is bank account and the account to be credited is capital. Number 2. Took out a long-term business loan of 5,000 sterling pound, the loan funds being deposited into the business bank account. So the account to be debited is bank account and the account to be credited is long-term loans. Number 3. Acquired shop fittings and a computer for the business. The total cost was 9,800 $800 sterling bound paid for using the business bank account. So the account to be debited is fixed assets and the account to be credited is bank account. Number 4. Made a transfer of 1,700 sterling bound from the business bank account to hold as cash. So account to be debited is cash account and account to be credited is bank account. The last one, purchase the inventory for resale by the business for 1,500 sterling bound payment being made in cash. So the account to be debited is inventory and the account to be credited is cash account. Explain what a journal is. Companies initially record the transaction in a chronological order and they occur. Thus, the journal is referred to as the book of original entry. For each transaction, the journal shows a debit and credit effects on specific accounts. Entering transaction data in the journal is known as journalizing. For example, the first column will be the date and then accounts title and explanation and then reference, debit and credit columns. If we have owner's investment of cash in business for $15,000, so the cash will be debit and the capital will be credit for $15,000. If we have purchase of equipment for cash for $7,000, so the computer equipment will be debit and cash will be credit for $7,000. Companies make separate journal entries for each transaction. A complete entry consists of number 1, the date of the transaction, number 2, the accounts and amounts to be debited and credited, number 3, a brief explanation of the transaction. Number 1, the date of the transaction is entered in the date column. Number 2, the debit account title, that is the account to be debited, is entered first at the extreme left margin of the column headed Account Titles and Explanation, and the amount of the debit is recorded in the debit column. Number 3, the credit account title, that is the account to be credited, is intended and entered on the next line in the column headed Account Title and Explanation, and the amount of the credit is recorded in the credit column. Number 4, a brief explanation of the transaction appears on the line below the credit account title. A space is left between journal entries. The blank space separate individual journal entries and make the entire journal easier to read. Number 5, the column titled Ref, which stands for reference, is left blank when the journal entry is made. This column is used later when the journal entries are transferred to the ledger accounts. Explain what a ledger is. The entire group of accounts maintained by the company is the ledger. The ledger keeps in one place all the information about the changes in specific account balances. Transferring journal entries to the ledger accounts is called posting. This phase of the recording process accumulates the effects of journalized transactions into the individual accounts. Example 2.2. The following examples are business transactions for a computer programming business during its first month of operations. On October 1, CR invests $10,000 cash in an advertising company called Pioneer Advertising Agency. On October 1, Pioneer purchases office equipment costing $5,000 by signing a 3-month 12% $5,000 note payable. On October 2, Pioneer receives a $1,200 cash advance from R, a client for advertising services that are expected to be completed by December 31. On October 3, Pioneer pays office rent for October in cash $900. On October 4, Pioneer pays $600 for a 1-year insurance policy that will expire next year on September 30. On October 5, Pioneer purchases an estimated 3 months supply of advertising materials on account from a supply for $2,500. On October 20, CR withdraws $500 cash for personal use. On October 26, Pioneer owes employee salaries of $4,000 and pays them in cash. On October 31, Pioneer receives $10,000 in cash from Coupa Company for advertising services in October. Required: shows the journal for Pioneer advertising for October. Shows the journal with all balances. The first column is the date, then accounts title and explanation, and then debit and credit. In the first transaction, the cash will be debit and the capital will be credit for $10,000. In transaction 2, office equipment will be debit and notes payable will be credit for $5,000. In transaction 3, the cash will be debit and unearned revenue will be credit for $1,200. Transaction 4, rent expense is debit and cash is credit for $900. Transaction 5, prepaid insurance will be debit and cash will be credit for $600. Transaction 6, supplies will be debit and accounts payable will be credit for $2,500. Transaction 7, the drawing will be debit and cash will be credit for $500. Transaction 8, salaries expense will be debit and cash will be credit for $4,000. The last transaction, the cash is debit and service revenues will be credit for $10,000.